Credit cards are businesses, and just like any other business, their goal is to maximize profit. Every one of those perks these companies offer exists because there's a business model behind it, one that encourages you to keep borrowing. It looks a little something like this. Congratulations, you've been approved for a higher credit limit. Earn 50,000 bonus travel points. 0% APR for the first 12 months. These offers aren't random, they're all part of the system. A system that keeps nearly half of all credit card holders in the US carrying a balance from month to month. In this video, we're going to break down every one of those systems, showing you the good, the bad, and the ugly of all things credit cards. And most importantly, how to put you back in control. The good. To understand why credit cards can be so dangerous, we first have to understand why they're so popular. Probably the most obvious of all the reasons is convenience. When you own any card in general, and especially credit cards, you unlock the luxury of not having to carry cash or write checks. You can pay almost anywhere with a quick tap, swipe, or click. Online shopping, booking flights, splitting bills, or making purchases overseas becomes fast and simple. And of course, you don't have to have all the money ready all at once. You can just pay it back at the end of the month. No biggie. Fraud protection takes things a step further. Unlike debit cards, a credit card isn't pulling money directly from your bank account. You're borrowing from the bank. So if someone steals your card information and makes fraudulent purchases, you're protected almost 100% of the time while the credit card company investigates. In other words, it's the bank's money on the line first, not yours. Then there are rewards, cashback, airline miles, hotel points, store discounts. Every purchase earns something back. But perhaps the biggest benefit of all is something you can't even see. Your credit score. Think of your credit score as your financial reputation. It's a number that helps lenders estimate how likely you are to repay borrowed money. The better your score, the easier it can be to qualify for things like mortgages, car loans, or even better credit cards. In some cases, it can even affect renting an apartment or the interest rate you're offered on a loan. Every month, your credit card activity tells lenders a story. Do you pay your bills on time? Do you stay well below your credit limit? Or do you consistently miss payments and max out your cards? Over time, those habits shape your credit score. And that's why so many people choose to use credit cards, even if they could pay with cash or a debit card instead. Credit cards are genuinely useful tools and in some cases essential. These are the parts companies want you to focus on. But one has to wonder, who pays for all these benefits? Credit cards are a multi-trillion-dollar industry and give away free money? As you could probably guess, credit cards don't offer all these perks out of generosity. They have lots of income sources that keep all your perks alive and keep the money piling on for them. But this first one doesn't even take money from you directly. But it's something almost every transaction has in common. Merchant fees. Every time you tap your card, the business you're buying from pays a small percentage of that purchase as a processing fee. That fee is then split between the payment network, like Visa or MasterCard, and the bank that issued your card. Ever notice how some small businesses offer discounts for paying cash? That's because accepting credit cards costs them money. Then there are account fees. Some cards charge annual fees in exchange for premium rewards, benefits, and general upkeep. Others charge late fees if you miss a payment, foreign transaction fees when you make purchases abroad, or cash advance fees if you borrow cash directly from your credit card. While not everyone pays these fees, enough people do that they make up another important piece of the business. But merchant fees and account fees aren't what make credit cards so profitable. The real money comes from interest. But before we go any further, there's one term you'll hear a lot when it comes to credit cards. It's the one tiny number hidden in the fine print that determines almost everything. IPR, or annual percentage rate. Simply put, your APR is the yearly cost of borrowing money if you carry a balance on your credit card. The higher your APR, the more expensive that borrowed money becomes. For example, if your card has a 20% APR, it means that over the course of a year, interest is charged at an annual rate of 20% on any balance you don't pay off. And that's why credit card debt can become so expensive, not just because of their astronomically high interest rates, but because of something else called compound interest. As long as you carry a balance, interest keeps getting added to what you already owe. Over time, that means you're not just paying interest on the money you originally spent. You can end up paying interest on previous interest charges as well. It's like rolling a snowball down a hill. At first, it's small, but with every rotation, it picks up more snow, which makes it even bigger, which helps it pick up even more snow. The farther it rolls, the faster it grows. Debt can work the same way. The longer you let it roll, the harder it becomes to stop. Every month, your credit card company sends you a statement showing everything you've spent during the billing cycle. If you pay your entire statement balance by the due date, you won't pay any interest at all. That's called your grace period. But if you don't pay the full amount, the remaining balance begins accumulating interest, which brings us to something that catches a lot of people off guard: the minimum payment. This is the amount the bank requires you to pay before late fees are applied and your credit score is impacted. And it's usually a whole lot less than what you've actually borrowed that month. Minimum payment can run you anywhere from 1% to 3% of your outstanding balance, or a flat fee of just $25 to $35. Banks usually pick whichever one is greater. If money is tight 1 month, they let you stay in good standing without having to pay off your entire balance all at once. At first glance, minimum payments can seem quite useful. But there's a dark side to it. Minimum payments also keep debt alive. Instead of paying a scary $5,000, you are given the option, say a measly $25. Suddenly it doesn't feel so bad. You make the payment, put the statement away, and move on. Meanwhile, most of that debt is still sitting there, slowly collecting interest month after month. The longer that balance stays on your card, the more money the bank earns. But here's what's really fascinating. None of these revenue streams explain why so many people end up carrying a balance in the first place. For that, we have to look beyond the numbers and into human psychology. Our brains didn't evolve to understand revolving credit, interest rates, or monthly billing cycles. They evolved to solve immediate problems, and credit cards take advantage of that. When you pay with cash, you physically watch the money leave your hand. You see it disappear, and your brain immediately recognizes that you've spent something valuable. Psychologists call this the pain of paying. Now compare that to tapping a credit card. There's no counting bills, no handing over cash, just a quick tap, and you're done. That tiny difference might not seem like much, but research has consistently shown that people tend to spend more when paying with credit than with cash. That is why many stores and businesses pay merchant fees, because it results in not just faster checkouts, fewer lost sales, but also customers who tend to spend more than they would otherwise. Next, we have debt normalization. As dystopian as it may sound, debt has become normal. Borrowing money is a part of everyday life. Need a car? Finance it. Want a house? Get a mortgage. Buying a new phone? Pay it off monthly. Even a pair of shoes can be split into 4 interest-free payments with the click of a button. Because borrowing is everywhere, it's easy to stop thinking of debt as something temporary and start thinking of it as just another monthly bill. Then there are offers. Remember that email from the beginning? Earn $300 when you sign up. 0% interest for the first 12 months. On the surface, these look like fantastic deals. And sometimes they can be, but they also change how people think. Instead of asking, do I really need this? People start asking, how many points will I earn? It encourages spending that might not have happened otherwise. And finally, we have the credit limit increase. Maybe you've received an email saying, congratulations, you've been approved for a higher credit limit. It feels like an accomplishment, a sign that you've earned more financial freedom. And in many cases, it is. A higher credit limit can actually help your credit score by lowering your credit utilization, as long as your spending stays the same. But that's the key. As long as your spending stays the same. For many people, a higher limit quietly changes the way they think. A $2,000 purchase might have felt expensive when your limit was $5,000. But after your limit jumps to $15,000, that exact same purchase suddenly feels much more affordable, even though your income hasn't changed by a single dollar. Your borrowing power goes up, but your spending power doesn't. It's a subtle psychological shift, but it's a powerful one. The number on your credit limit isn't a recommendation for how much you should spend. It's simply the maximum amount the bank is willing to lend you. None of these tendencies make someone irresponsible. They're simply part of being human. And the companies issuing credit cards have access to resources that allow them to understand human behavior extremely well. The good news is that once you understand the system, you can break free of the rat race. Rule number 1, never spend money you don't already have. Treat your credit card exactly like a debit card. If the money isn't sitting in your bank account today, think twice before putting it on your credit card. Doing that allows you to avoid interest completely while still taking advantage of rewards, fraud protection, and the opportunity to build your credit score. Rule number 2, don't chase rewards. Getting 2% cashback isn't saving money if you spent money you never intended to spend in the first place. Rewards should be a bonus, not the reason you make a purchase. And finally, understand what you're signing up for. Know your interest rate, know your fees, know your due date, because the more you understand your credit card, the less likely you are to make expensive mistakes. Credit cards are simply tools. Used carelessly, they can become one of the most expensive forms of debt you'll ever have. The difference isn't the piece of plastic in your wallet, it's whether you understand how it works. Banks certainly do. And now, you do too. If you enjoyed this video, you'll probably enjoy my video on how the world runs on debt, where we uncover the bigger picture of why debt has become the foundation of our entire economy, and what that means for all of us. And finally, don't forget to leave a like and subscribe for more videos breaking down the world of money, economics, and everything they don't teach you in school.